Good morning, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheksisi, your tutor and your mentor. So basically, today we are going to start looking at consolidation. We are going to look at the basic aspects of consolidation, the concept that you need to know before we are going to look at the more complex areas. So today we are going to look at the group definition, what is the meaning, the definition of group structure. And also, we are going to look at the relationship between the parent and the subsidiary. Why are we going to consider a company to be a parent, and why are we going to consider a company to be a subsidiary? And also, we are going to look at the concept of the single entity because the parent will be a legally owned company independently from the subsidiary, while the subsidiary, on legal terms, will be an independent company. But when it comes to consolidation, we need to put both parent and subsidiary together so that they can form a single entity which we can use to prepare our consolidated financial statement. And also, we are going to look at the exclusion from consolidation. Then, basically, we are going to look at the principle of consolidation. When are we going to add? What we should add? Whether we should add the assets of both the parent and subsidiary, whether we should only consider the retained earning of the parents rather than the subsidiary concept that you need to know to consolidate both the financial statement of the parent and the subsidiary. So basically, let's understand the definition of a group. When we are talking about the group structure, you know, we can say if a company owns more than 50% of the ordinary share of another company, then we can say that company that owns more than 50% is the parent company, and the other company can be the subsidiary. This is clear. The parent company that owns more than 50% in the ordinary share is what we refer to as the parent company. So now, what exactly that percentage is telling us? In further aspects, we are going to ignore the concept of percentage because according to IFRS 10, it is not only limited to the 50% before we are going to confirm that this is the parent company, but also we are going to look at other factors that will indicate the possible control by the parent company. So basically, owning more than 50% of the ordinary share of a company will give a company certain criteria and a certain benefit that is very important for the parent company to know. Firstly, this will usually give the first company a control over the second company, which is very clear. Another benefit is that the parent company will have enough and sophisticated voting rights to appoint directors, to make a strategic business decision, to appoint some board members and to make a strategic and financial decision for the company. That benefit, you will have it as a parent company because soon as you own more than or greater than 50% of the ordinary share of any company, you will have this right. Another point is that the parent company can manage the subsidiary, Then when we are going to look at the intergroup transaction, the trading between the parent company and the subsidiary, we are going to look at how we can adjust for intergroup transaction and how we can adjust our, you know, other related transaction between the parent and the subsidiary. For example, the unrealized profits, we are going to look at it separately. Then in finite term, the in strict legal term, the parent and the subsidiary remain distinct. It is very clear. Now, for example, I decided to invest in another company. My company is an independent company. The parent company, the subsidiary company, sorry, is an independent company. But let's assume I own more than 50% of that particular subsidiary company. So it means when I am going to prepare my consolidated financial statement, in legal term, both company A or the parent company and the subsidiary company, they are distinct. They are not the same company. They are working independently from each other. But when it comes to consolidation, we are going to put we are going to look at the economic substance of the transaction. Therefore, we are going to treat the parent company asset and liability and equity, as well as the subsidiary asset, liability, and equity expenses, whichever. We are going to consolidate these guys. We are going to put these figures together so we can have a single consolidated financial statement, which we can use to make a informed and a strategic decision, which is very much important. That's why when we are going to look at the exemption from the consolidation, one might be if the subsidiary performance is so poor that it will give a bad presentation when it comes to the consolidated financial statement, we might, as a parent company, need to exclude. We can't prepare a consolidated financial statement in that particular situation, but we are going to look at it separately. So basically, this is the definition of a group. When a parent company or when a company owns more than 50% of the ordinary share of another company, you will have these four rights, which is very much important. So now we are going to look at the group financial statement, which is a key principle. When we are talking about the group financial statement, it means we need to reflect the economic substance of both the parent and the subsidiary as a single entity. So we are going to look at the relationship of the parent and the subsidiary. We are going to look at the financial statement of the parent, the financial statement of the subsidiary, and we are going to put them together in the form of a group structure, in the form of a consolidated financial statement. So, as I mentioned earlier, the parent company is an individual legal entity by its own. The subsidiary also is an independent legal entity on its own. But soon as there is a group structure, soon as the parent controls the subsidiary, soon as the parent acquired more than 50% of the ordinary share of the subsidiary, it means, therefore, we are going to form a single entity which can be called the group. So now, basic concept that you need to know for the consolidation. So now we are going to look at the definition according to IFRS 10, consolidated financial statement. We use this the following definition, which is very important. You need to know what is parents, who can be the parent, and when we are talking about the parent within the group structure, any company that has the controllability factor that can, you know, that can make a strategic business decision or that can benefit for any variable consideration, we can say that particular company is the parent company, whether it owns more than 50% or it's less than, but we are going to look at additional factors that will be considered before we are going to decide whether company A is the parent or whether company B is the parent. Subsidiary, very important. An entity that is controlled by another entity is what we refer to as the subsidiary. That is, the parent company controls the subsidiary. So now, when we're talking about control of an investee, very important, an investor controls an investee. The parent company controls an investee, the subsidiary, when the investor exposed, when the investor exposed to a variable return or has the right to a variable return, or whether the investee has the ability to affect that particular variable return. These 3 points, we are going to look at it separately because even for strategic business reporting area, this is the point that you need to do because you will be asked to identify whether to look at factors that will indicate that the parent has control over the subsidiary or not. So you need to make reference of these 3 points, but we are going to look at it separately in the following section. So now we have the requirement for consolidated financial statements, which is clear. According to IFRS 9, the circumstance precipitate the group structure should be known. That's why we are going to prepare the consolidated financial statement. So now let's understand what is control because it's key. For us to prepare a consolidated financial statement, there should be a control. There should be, and it's a must, control is to be exist because the concept of control will give rise to the preparation of the consolidated financial statement because the parent company is an independent legal entity on its own, while the subsidiary is an independent and legal entity on its own. So, for us to prepare a single group structure that can show the controllability of the parent company and the subsidiary, we need to ensure that these three features are present before we are going to consider the preparation of the consolidated financial statement according to IFRS 10, which is the presentation of the consolidated financial statement. First condition, the investor, the parent company, the company that owns more than 50% of the ordinary share should have the power over the investing. Very important point to note, the parent company should have the power over the investee. So now what is the meaning of power over investee? Which is very important for you to know for the examination. When we are talking about power over the investee, it means the parent company should have the right to make a strategic business and informed decision. The power over the investor, the parent company should have the right to make strategic decision, business decision, or informed decision. That is, the parent company, the parent company, right, should have the right to choose or select the directors, the board members, the board members, and to make informed decision. So when we are talking about power over the investee, it means the parent company should be able to select directors, to select the board members, or to make informed decision about whether to secure a long-term finance or whether we need to look at another alternative source of finance, whichever strategic decision that can result to a future growth of the business or decision that can impact the going concern, the prospect, the growth of the business. That decision is very important in any business environment. So if a control is existed, it means the parent company should drive the decision making, should drive the selection of board members, should drive the selection of the audit team, whichever the case might be, because that's why we are going to look at not only the 50% of the ordinary share, but we are going to look at the concept of voting rights, which is very much important according to IFRS 10, because 50% ownership is not sophisticatedly enough to justify that there is an existence of control. But if the company, the parent company, has more than 50% voting rights, voting, I'm not talking about ownership, I'm not talking about um, ownership again, percentage of ownership on the ordinary share. I'm talking about 50% voting right. If the parent company has the 50% voting right, it means there is a clear indication of the existence of control backed up with these three conditions. So don't forget, the question might tell you that out of the 10 board of directors, the parent company has 7 representatives from out of the 10. So it means 70% of the voting right is within the parent company. So automatically, if there will be any strategic decision, they will vote for that particular decision or against that particular decision. They are the drivers. They will be the key players within the group structure. So they can dictate and they can pressurize, they can give a recommendation as to whether they need to comply with this financing decision or whether they need to remove this board member or whether they need to make a strategic business decision. So that percentage of voting rights is very much important under the consolidated financial statements according to IFRS 10, which is very important for you to note. The second point, the second point, when we are talking about controllability, there should be an exposure or the right or to a variable return from its investment with the investing. So now what this is talking about, it means The investment in the investee, the investment of the parent to the subsidiary should give the parent company some variable return. That is, the parent company should be benefiting should benefit from the dividend. For example, dividend, we can say growth, we can say the synergy, and we can say any prospective business opportunity. Prospective business opportunity. So now, when we're talking about the right to a variable return from the involvement within the investee, this should be considered. The benefit that the investee will have from investment, for example, we are going to look at the prospect of the subsidiary. If the subsidiary can earn more profit, then the parent company should be able to benefit from that profitability in any form, whether it's a dividends that will be issued, whether it will be a prospective growth, whether it will be a new business opportunity, whichever the case might be. The parent company, the investor, should be able to have that exposure right, to have that right to a variable return because of that investment that is made. The final point, which is very important, the ability to use its power over the investor to affect the amount of return by the investor. In other words, we are going to look at the relationship between return and investment. Controllability will give the parent the absolute right over the investee to make to affect any amount in terms of investment, in terms of return. In other words, from the power over the investee, if the company need to vote as to whether we need to issue our dividend or not. We are going to do the voting. Now, let's assume the parent company owns, or the parent company has more than 50%. Let's assume 70% of the voting rights. So, therefore, if we are going to vote whether we need to issue dividend or not, then 70% of the members will be voted in line with the issue of dividend or not. So that conflict between the risks and reward is what is very important to consider when we are analyzing the aspects of controllability. So, according to IFRS 10, you need to know these 3 points before you're going to consider the existence of control. Once there is a control, then we are going to prepare the financial statement provided other conditions. But don't worry about it. Let's try to understand the establishment and the existence of control. Very important for you to know. You need to review this point. It might be tested from the objective test questions, you know, also from section C, consolidation, probably the concept will be tested for you to explain whether there is an existence of control, looking at the group structure, looking at the number of directors, and looking at the X, Y, and Z directors owned by the parent and the subsidiary. So you need to bring these points out and you need to try to link it up with the scenario. But this, is frequently tested for strategic business reporting because for any consolidated question, the concept might be there because if we are going to talk about, um the different aspects of consolidation, that is when we are going to sell portion of the NCI, so we are going to assess whether the remaining portion can enough to be controlled or not. Don't worry about it. We are going to look at it separately under the strategic business reporting. So for now, you need to know these guys and you need to try to understand it as best as possible. So now basically under IFRS now we are going to apply the principle-based approach as per the conceptual framework. So we have the option to make a judgment as to whether there is an existence of control or not, provided these features are met. So the judgments, can be guided by the concept under IFRS 10. You are not going to make any judgment based on sentiments or based on what you think can be. No, the judgment should be guided by the conceptual framework, by IFRS 10. So now we need to look at some exemption. Don't worry about it. We need to look at some exemption from the preparation of financial statement for a group. So now we need to look at why are we not going to, regardless of the control, regardless of this, but yet still, in such a situation, we are exempted to prepare a group financial statement. One, which is very much important, if the parent company in by the parent company alone produces a consolidated financial statement that is in line with all IFRSs, and that financial statement is made available to the public, then therefore there is no need for us again to prepare a consolidated financial statement. Very important concept, very important point to note. Another important point, if the parent company, when I'm talking about parent company, it means company that owns or that has control over the subsidiary. If the parent company, debt or equity instruments, when you're going to look at IFRS 9, the concept of debt and equity instruments are not traded in the public market. Very important. If the debt and equity of the parent company are not traded in the stock market, then it is an exempt situation for us to prepare a group financial statement because it's a waste of time. Another point, if the parent company did not file its financial statement with a scrutiny, with a security commission, for example, they did not prepare any financial statement in line with IFRSs, in line with IPSAs, for example, if you're talking about the public sector, in line with any other security commission or regulatory framework, then that particular financial statement is not enough to be presented in a group structure. So we are not going to consider that financial statement. It will be exempted from the preparation of the group financial statement if I'm talking about the parent, because the parent company has control over the investee, which is the subsidiary. So anything that has to do with the parent company debt and equity instrument that is not traded, we can't prepare a group financial statement. If the parent company did not file its financial statement in line with the Security Commission or any other regulatory body, IFRS, IESs, IPSAs, whichever regulatory body, then we can't prepare a group financial statement. Finally, if the parent company by default on its own, the parent company itself is a wholly owned subsidiary. The parent company is a parent company of a subsidiary, then also that parent company is a subsidiary on its own. For example, I am the parent company. I have, let's say, company B is the parent company, and company C is a subsidiary. Also, company B, which is the parent company, is a subsidiary of another company, which is company A. So in that situation, when we are going to look at the related party transaction, we are going to analyze, how we can disclose the related party transaction. So if the parent company is a wholly owned subsidiary, 100%, or it's a partially owned subsidiary, then therefore we are not going to prepare a group financial statement in that situation. So these are the conditions that we are going to look out for before we are going to exempt any parent company or the preparation of the consolidated financial statement. Also, we are going to look at IAS 27, the separate financial statement. When exemption from the preparation of financial statement is permitted, when the exemption is permitted under IAS 27, which is a separate financial statement. Firstly, the fact that the consolidated financial statement has not been presented. The list of significant investment, that is the subsidiary, the associate, we are going to look at it under IAS 28, the associate, including percentage of shareholding. So now we are going to look at reasons for wanting to exclude a subsidiary. Why do we think we should exclude a subsidiary? I mentioned it at the introduction aspect. If the performance of the subsidiary is poor, absolutely poor, that we can't consolidate both the parent and the subsidiary because of the poor performance of the subsidiary. Also, if the financial position, the asset balances, the liability, and the equity, they are very poor when you're looking at the financial position, then also we can't, produce, we can exclude the subsidiary from that particular group structure. Then if we have different activity of subsidiary from the rest of the group, different, the subsidiary might have different activities which are not in line with the group structure. So we can't include that particular subsidiary. But however, these reasons are not permitted under IFRS accounting standard because the performance can be poor. And the reason why we are going to prepare the consolidated financial statements is for the parent company to boost the performance of the subsidiary. Because when we are going to prepare the consolidated, any poor performance of the subsidiary will affect the group structure. So it is the responsibility of the parent company to ensure the overlook, the monitor, the subsidiary. That's why they have control. They can influence the strategic decision. They can influence the board of directors. They can able to inform and make the financial and business decision. So now, according to IFRS 10 and IAS 27, why are we going to exclude subsidiary? The reason, subsidiary held for sale, we are going to exclude it. Now, what do I mean by subsidiary held for sale? We have an accounting standard which is IFRS 5, a non-current asset held for sale and discontinued operation. Now, IFRS 5 is telling us that soon as we have classified a subsidiary or a non-current asset to be held for sale, the accounting treatment automatically will change because we are going to recognize it as non-current assets in the financial statement. We are going to recognize because any asset that is classified as held for sale, we have the condition should be sold out within a 1 year period. So it has become a current asset to the business. Don't worry about it. We are going to look at it separately. So if a subsidiary is classified as held for sale, we are not going to we are not going to include that subsidiary in the preparation of our group financial statement. We should not include it because it will be held as current asset investment in the statement of financial position under the current assets. That's I mentioned earlier. This is exactly what IFRS 5 is telling us. Another area why we are going to exclude the subsidiary is immateriality. The accounting standard do not apply to immaterial items. For example, the financial statement of the subsidiary is immaterial, very minimal, it's not significant to make any strategic decision. Let's assume the parent company makes an annual profit of $10 million, while the subsidiary is 1,000, or 500, or let's say 20,000. It's not material. So therefore, we should not waste our time to consolidate, to prepare, to add the assets of the parent company and the subsidiary together. So these are the reasons why we should exclude according to IFRS 10 and IAS 20. And also we have another reason, for example, the non-conterminous year ended. Now, in the year life, it is practical that the financial period of the parent company cannot be the same of the subsidiary. For example, the financial period of the parent company and the financial year of the parent company ended in December each year, whilst the financial period for the subsidiary ended in June each year. So there's a gap between the reporting period of the parent company and the reporting period of the subsidiary. So now, what the standard is telling us that in this particular situation, in real life, it's practical because of the different financial period. So what the standard is telling us that IFRS 10 allowed us to ensure that the subsidiary financial statement made up some additional information to dates that will match up with the financial statement of the parent company for more than 3 months earlier or later than the parent reporting date, with due adjustment for significant transaction or other events between that date. Very important point. So all of these points, what you need to know according to IFRS 10 is this. Then also we have a uniform accounting policy. In a situation, it's practical that the accounting policy of the parent company and the subsidiary cannot be the same. In real life, they cannot be the same. So, we are going to look at how to ensure that we prepare a financial statement, a group financial statement in that line. So if a member of a group uses accounting policy other than those adopted in the consolidated financial statement for like transaction, an event in similar circumstance, appropriate adjustments are made to that group member's financial statement in the preparation of the consolidated financial statement. Ensure conformity with group accounting policy. So basically, for today's session, we are just going to do just brief concept. And in our next session, we are going to look at the consolidated financial position, which is we are going to look at the detail of consolidation in year life, how we can add the asset and liability of the parent and subsidiary, and also how we can do some adjustment in terms of our 5 steps calculation of our group structure, calculate our net assets, calculate our goodwill, calculate our retained earning, and calculate our NCI. Thereafter, we are going to prepare a sample of a full group consolidated financial statement. So thank you very much for your time.